Thank you for joining us. We are discussing investing and taxes for Americans living in Europe. We will have a Q&A session at the end, so yes, certainly submit any of your questions via the question chat box. Please note that the webinar is not for is purely for informational purposes. It is not intended to offer advice or guidance on legal, tax, or investment matters. Such advice can only be given with full understanding of each person's situation. My name is Mananta Moorman, and I'm the Director of Business Development at Greenback, and I have the honor today to introduce you to our expert panelists. So first, we have Michelle McKeon, who will kick things off for us to talk about US tax considerations when investing in Europe. Michelle is a Greenback expat tax accountant and an IRS enrolled agent with Big Four experience. After starting her career in corporate finance, she pursued a master's in accounting to focus on individual taxation. She found her niche in expat tax and now serves Americans abroad. Originally from New York City, Michelle has lived in Argentina, Switzerland, and now in Portugal. Outside of work, she enjoys rock climbing, trail running, and riding her motorbike. Following Michelle, we'll hear from Shane Clark, who is the president and co-founder of EuroAmerican Financial Advisors. Shane holds the European Financial Designation and specializes in financial advice and investment management for Americans in Europe. He has over 10 years of experience in international financial markets and has been an expat himself for 15 years. Shane holds an MS in Financial Economics and an MPhil in Economics from the University of Strathclyde. Today, he resides in Spain. All right, so let's get started. First, I'll hand it over to Michelle.
Minotaur, there we go. Okay, great. I would like to see the screen. Perfect. Okay. So we're on the end slide. Awesome. Great. So hi, everybody. Welcome. Here we go. Investing and tax considerations for Americans living in Europe. Today, we're going to be talking about key tax considerations for Americans who are living or working in Europe. We are going to talk about the reporting requirements that you may have for foreign assets and foreign investments, which includes FATCA, which is Form 8938, FBAR, which is Form 114, and PFIX, the 8620s. We will also be talking about implications in the US for having non-US retirement accounts, and we will talk about having real estate outside the US and what that means on your US return. And we will have some tips and tools and practical things to optimize your complicated cross-border financial situation. So let's get into it. So how and why your investment decisions will change when you move from the US to Europe. For one thing, the most important thing is that when you're living in the US, you're filing US federal, state, sometimes local returns. When you're living in Europe, generally you're going to continue your US filing obligations because of your citizenship, and you will probably most likely also have a European return filing obligation because of your residency. Your worldwide income will probably be reported on both returns, and there are double tax issues that need to be sorted out on one or both sides. So basically, when you make an investment, you're no longer straightforward thinking of what's best for me in the US, but what's best for me in Europe and the US, what's best for my situation overall. Currency fluctuations are a huge point that we should be thinking about when we're making any type of investment. For example, something that I have seen happen many times in my career is that someone purchases an investment like stock or even a home, something like that. They obviously purchase it in their local currency. Let's say you buy a house in Germany, you purchase in euros. Many years pass and you finally sell that asset, you sell that stock, or you sell that house. When you're calculating your potential gain for tax purposes, and you're purely looking at, I purchased it in euros, I sold it in euros, you could have, for example, a loss. You could have overall lost money on this asset. But when we report that sale on your US return, we are converting your original purchase in local currency into US dollars. And we're using particular exchange rates from that day. So it has happened, I have seen it happen, that someone that has a loss for their local European return purposes actually has a gain for US purposes. When you convert everything into US dollars, you've actually made money and you owe tax on that income. You potentially don't have foreign tax credits to offset your US tax liability because you didn't owe any tax in Germany, for example, because it was a loss. That's a major thing to think about when you're making investments, is to keep the conversion rates in your head as you go. FATCA and FBAR reporting adds an additional compliance layer. These are just additional forms that you have to think about filing that a lot of US residents are not aware of, and US tax return preparers also not aware of, haven't heard of them, don't usually file them. It's just something to keep in mind, that maybe your US tax return will have a few additional forms that you've never heard of that you have to start getting really familiar with. Certain investments you make or accounts that you might think of. For instance, if you have some type of employer pension, depends on the type of pension, of course, but maybe this is a type of pension where you're not actually receiving any distributions yet, you're just making contributions, you're still a young unretired person. So you think like, great, there's nothing to do, don't have to report it on my US return, I'm not making any money, but you potentially do have to report the value in the account on these informational report forms, the Form 8938, which is FATCA, and the FBAR Form 114. So foreign products. So these they may be inefficient for US tax purposes. I think this is the crux of the presentation here. And the biggest point that we kind of want to convey is that when you're in the US and you go and you talk to a financial advisor or a tax advisor, and they say, I looked at your situation, I have this product for you, this is going to be great for you, it's going to lower your tax bill, it's going to be great for you when you retire, this, that, and the other. And you can trust them, they're probably right, they know what they're talking about, it's great. If you do that in Europe, if you go into you find a financial advisor, a tax advisor, and you say, like, I'm looking to invest in money, and they're like, great, we can do this, we can do that, we can do that, all these flashy, wonderful things. It's going to lower your tax bill so much, it's going to save you so much money. The issue is that while that may be true in your European resident country, it's probably not true in the US, and actually it could be the opposite, that you're actually being harmed for US tax purposes. So the best case scenario is basically that you don't get any tax benefit for making this European investment on your US return. So you're not getting any kind of deduction, or you're not lowering your taxable income in any way. That could be one impact. The more common impact, or the bigger impact to be more concerned about maybe, there are actually some investments that you can make that the US goes beyond just not granting any deduction or something like that, but they actively punish you for having these type of investments on your US return. So basically, we have situations in which stocks, things like that, that are simply held, not even sold, but just being held year to year, the unrealized gain and value of these assets that haven't been sold is being reported annually on your US return. And that gain is being taxed at the highest possible US tax rate. So not your personal tax rate, but the highest tax rate permissible under the law. So in this situation, you have investments where you're not actively getting any cash in your pocket, but you are paying cash out of pocket in gain that doesn't even actually exist yet. It's just unrealized gain. You haven't actually sold the assets to make that profit. This is one of those situations, and when you have to be really careful about what type of investment you're getting into and whether the tax benefits that it's conveying for you in Europe are actually going to carry over onto your US return. Lastly, tax treaties. Tax treaties and foreign tax credits. These are huge tools for you to use when you're living in Europe. Tax treaties often have special tax rates for income like dividends, stock gains, even retirement distributions, things like that. Foreign tax credits are going to be super essential if you are paying income tax on any income to your European residence country, for you to make sure that you're not double paying that also on the US side. So these are two really important tools. If you're not taking advantage of them while you're living in Europe, definitely talk to a tax advisor who can help you out there. Compliance must-knows. So these are some of the forms that we potentially need to file when we have assets outside of the US. FATCA Form 8938. So this form and the one below it, the FBAR, the FinCEN 114, these are two informational reporting forms, which means no taxes due. It's purely disclosure. It's just reporting. These two forms are reporting the highest balance in each of your non-US accounts during the year. Your non-US accounts include very straightforward things that you would think of as accounts, like checking accounts, savings accounts, things like that. Also, on these forms, we need to report private pensions. Also, just generally some employer pensions, depending on the country, depending on the type of pension. They also need to be reported on these two types of forms. If you have mutual funds, things like that, investments in brokerages, those will also need to be reported on these two forms. The differences between the forms is that Form 8938 is actually part of your tax return. It's filed with your normal return. The same deadlines that apply to your tax return apply to the 8938 because it's all part of the same filing. The FBAR is a completely separate filing. It's not part of your tax return. It's filed with a different authority. The other difference is that the threshold is much higher for filing the 8938 than the FBAR. The FBAR threshold, very straightforward, 10K. This is looking at the highest balance in each individual account and the cumulative total of all those highest balances. So people often give me an example and say, I don't have to report, I have 4 accounts, they each have over 12K. I also have an account in Greece, it only has 2K in it. I don't need to report it on the FBAR. That's not true. Once the cumulative highest balance across all accounts hits 10K, you have to report all of your accounts, even if they had $0 in them throughout the year. If the account was open during the year, it needs to be reported on the form. The 8938 threshold is much, much higher. The exact filing thresholds depend on your marital status. If you're, or maybe not even your marital status, but the marital status that you are filing with on your US return. So if you are a US citizen that's married to a French citizen, and that French citizen is not a US person and it's not part of your return, you're going to have a filing threshold for single or married filing separate people. So the threshold looks at your marital status and where you were resident during the year. So if you were resident in a foreign country for the entire year, you have a different filing threshold, much higher filing threshold than someone who was living in the US for most of the year or the entire year. PFIC pitfalls. So PFICs, these are passive foreign investment companies. This is what I was talking about in the last slide, where it is possible that if you make certain investments in certain non-US brokerages, you are not getting the advantages that you get if you were to make investments in US brokerages. These are the situations in which you have unrealized gain that's being taxed on the US return each year at the highest possible rate. You also have extremely complicated tax forms to fill out as part of your tax return every year. I would suggest not if you have PFICs, I would suggest talking to a tax professional at least for 1 year, and so you can kind of see how the form is done, and then maybe you can continue on doing it yourself. The forms are extremely complicated. The penalties are extremely high. The tax prep fees are usually quite high as well. PFICs are generally something that we try to discourage US persons from investing in unless they are very sure about their overall situation, how it's going to impact them both in their European residence country and in the US. But yeah, generally the US has set up its tax laws to encourage US persons to invest in the US. It doesn't want you to put your money outside of the US. So our tax laws are set up to make sure that your money is being funneled exactly where the government wants it to be. Compliance strategy, how to avoid PFICs and situations like that. Investment in the US is generally always advised for US citizens, US green card holders, US residents. And Another option is to directly buy individual stocks. So rather than investing in certain funds or certain brokerages or things like that, to just individually purchase stock. That's completely fine. You'll avoid these PFIC reporting requirements generally. Yeah. So our next slide, we are talking about retirement assets and real estate assets. So foreign pensions. This is a hard topic to talk about in a very general presentation when I don't have a lot of time. So generally, foreign pensions. Be careful with foreign pensions. If you are a person that has a foreign pension, look into exactly what it is. Maybe talk to a tax professional to figure out what's going on. Don't just Google it. That's a bad idea. There's horrible advice out there. There is certain type of pensions that are no problem, easy peasy, everything's great. Other types of pensions, there could be situations in which even if you're just making contributions to the fund each year, there could be situations in which those contributions are taxable income on your US return. And there could be situations in which any income that's being generated each year by the foreign pension, ideally they're earning things like interest, maybe they're selling stocks, things like that. That income could also need to be reported on your US return. There could be situations in which foreign pensions are treated like trusts, in which you have trust reporting situations. You need to file a trust return with your US return. Generally, if you have an employer pension that the employer contributes more money or equal money that you do, and you can't access any funds until retirement, generally, that's going to be a situation in which income is not being reported on your return. You can leave it until you start getting distributions and then worry about who's taxing what and at what rate and with what treaty benefits. But yeah, there could be situations in which income needs to be picked up and reported on your return each year. Almost certainly any benefit that you're getting in the foreign country for making contributions to the pension are not going to be recognized by the US. So you're not going to reduce your US taxable income by the amount that's being contributed to the foreign pension. US retirement accounts may have contribution or withdrawal complications while abroad, definitely. Once you start withdrawing from a non-US pension, there are situations in which the entire distribution needs to be reported on the return. Sometimes it's partial distribution. Sometimes we need to do a completely different calculation. But what won't necessarily happen is that the income that's being reported on your foreign return will match the income that's being reported on your US return. So you have to be kind of careful when you're preparing returns, having things done. Or maybe you expect, oh, in my country, the country where I live in, my retirement distribution is tax-free. I don't owe any tax on it. That's probably not the case in the US. You will probably definitely owe tax on any retirement distributions within the US. So that's an important planning step if you're thinking of getting money tax-free later on when you retire. Remember your US taxes. Rental income and capital gains are taxed differently by each country. So yes, again, similar thing that I hear from clients a lot. I sold this stock or something like that. Only the first 25% of it is tax-free in my EU residence country, so I only owe tax on the 75%. That's all well and fine for you, your EU residence country, but the US is very likely going to tax 100% of the gain. So the US is running its own calculations on its own tax laws, and it's not really looking at or considering any tax relief you're granted by your residence country. For EU real estate, if you have purchased a house in the EU, and you sell it, you are eligible for the same exclusion that you would get if you had a main residence that you sold while living in the US. So this is called the Section 121 exclusion. This exclusion applies for your main residence. So you have to have lived in the property as your main residence for at least 2 of the last 5 years before selling. If you file a joint return in the US, your spouse must also have lived in the property for 2 of the last 5 years, and you can't have elected the Section 21 exclusion recently. So the exclusion allows you to exclude from US taxable income up to $250,000 of gain on the property and $500,000 if you're married and filing jointly on your US return. The gain that we're talking about here, once again, is your total gross selling proceeds converted into US dollars using the daily rate for the date that you sold, minus any selling costs, so legal fees, broker fees, inspection fees, anything like that, any costs that you incurred to sell the property. All of that gross profit minus costs, minus what you originally paid for the property and any costs you originally paid to purchase the property, inspection fees, broker fees, anything like that, once again. So that amount, all in US dollars, is your total taxable gain, and you are eligible for the Section 121 exclusion. Even if the house is outside of the US, you can still use this exclusion on your US return. Finally, we have the foreign housing exclusion and tax treaties for relief. So the foreign housing exclusion is a provision that's part of the foreign earned income exclusion. So if you are living and working in Europe and you are claiming the foreign earned income exclusion to reduce your US taxable income, you can also claim the foreign housing exclusion, which allows you to for any housing, non-US housing costs that you're paying, so rent, utilities, parking, repairs, things like that. It's an additional exclusion on top of the foreign earned income exclusion to reduce your US taxable income. Tax treaties are a great resource for figuring out special rates that may apply between you and your foreign country. Also, some provisions may be tax privileged, or tax may be deferred in the US until tax is applied in the EU country, for example. So tax treaties can be very important, really good tool to rely on. I think that's it for my presentation. Shane is coming up next. Thank you everyone for listening. If you have questions, please save them until the end. You can write them in our Q&A box, and we'll have a Q&A at the end of everyone's presentation. Thank you.
Great, thank you so much, Michelle. Yes, thank you everyone for the questions that's coming in. We will certainly make sure to address them at the end. And now I'll hand it over to Shane to talk about investing as an American in Europe.
Great, thank you very much. Thank you everybody for attending. My name is Shane Clark. I'm the president of our firm here in Spain, EuroAmerican Financial Advisors. We also have a sister firm in San Francisco called International Asset Management. That company's been around, founded by my partner, Tom Zakistel, for just over 22 years now. So I think we have clients in 35 countries. We set up this company in Sevilla, licensed with the Spanish investment authorities around 4 years ago, really to focus on our clients in the EU and to better understand the joint tax treaties, local laws, all of the fun stuff in being an expat. Excuse me. So without further ado, let me jump in here. So I kind of wanted to start off by giving you a little bit of an overview about why it's so complicated being an American expat living in the EU. So the pillar of the problems, you could say, start with citizenship-based taxation. So when you're born with the US, the blue passport, you move over here, you still need to file the US tax returns, and that creates a lot of the issues. As Michelle was talking about, FATCA, from our perspective, the issue there is this piece of legislation means that any banks, brokers, custodians, either in the EU or the US, need to report information about your accounts to the corresponding tax authorities. And as you could probably guess, that's being an expat, that's a very small portion of the company's total revenue. So someone like Goldman Sachs, Morgan Stanley, Merrill Lynch, when we still had Smith Barney, places like that, they don't really deal in the expat world anymore. Once FATCA came around, they decided, it's not worth it from a compliance standpoint, from the few people we're getting in revenue to continue working with expats. So they started closing accounts. And that's often how we meet our clients. You might receive an email, a letter that says, okay, you've told us you're an expat, now we can no longer work with you. Worst case scenario is they close your account, they send you a check. Usually it's more, they freeze the account. So you can't do any more trading in terms of buying. You can just sell or close positions. So that's really the big impact in terms of investing. FBAR, I think we've already discussed. PFICs, don't buy them. We'll talk a little bit more about it. MiFID is, what our legislation is. So being licensed in Spain, we can passport our license to 11 different countries, Western Europe in particular, and also Greece. And that's the piece of legislation that regulates us as investment advisors, but then also guarantees your rights as a retail client. So it's important to work with a firm who's actually licensed in the EU and understands, what your rights are, and then also for you to understand what, options you have in case of a bad situation. PRIPS, that's a mouthful, packaged retail investment and insurance-based products. So a lot of times people ask, why can't I buy US ETFs? This is why, PRIPS. So this piece of legislation states that in order for a US exchange-traded fund to be offered in the EU, it needs to have this document that's called a key information document. The US funds don't produce this document because the Securities and Exchange Commission says you can't do it because you have to forecast performance on it, and you can't forecast performance. So that's the reason why you can't buy US ETFs. And then you're left in this pickle if you can't buy foreign mutual funds or exchange traded funds or US mutual funds or US ETFs. What do you do? There's a little bit of a workaround, which we'll talk about with regard to the US ETFs, but in general, you might be looking at an all stock portfolio. So what we do is we offer cross-border investment advice. So we structure your investment portfolio in a way to optimize the taxes, both domestically and then back in the US, and also maximize your return for your given level of risk. And then we coordinate, with your financial team to make sure this is all compliant and tax efficient. So we work with someone like Michelle to file your US returns, and then somebody locally to file your returns in France, the Netherlands, Germany, wherever it is that you live. And each country's local taxes are very different. So some countries, they tax capital gains the same as they tax ordinary income. Other countries, they tax dividends and interest, passive income differently, maybe at a higher rate, ordinary income rates versus capital gains. So it's important to have a keen understanding of all that and work with people who understand not only the joint tax treaty, but also, that you're from the US and you've got a lot of other considerations. The other service we offer is financial planning. And I'll talk more about that, but essentially that's looking at your current situation, creating a financial profile, incorporating any goals you have, and then projecting that into the future. So in general, we always advise, if you have an advisor that you trust in the US, they're probably very good at what they do in the US, but once you move across the border, you need a cross-border advisor. So you need someone who understands the additional risks, the additional complications, and someone who's licensed to provide advice, but then also someone who has designations to know what they're doing. So myself, for example, I have the European Financial Planning designation. My partner, Tom, in the US has the US CFA and CFP, Certified Financial Planner. So we understand both sides of the pond and what we need to do in order to make things efficient, but also compliant. And both of us are expats as well. I left originally from the US. I left Detroit in 2008. So I've been an expat for some time now. Lived in Spain for the past 8 years. So we've seen a lot of different situations, professionally, but also personally. And this is an important thing. Oftentimes when someone jumps on a call with me, they ask, is there anything I'm forgetting or anything I should be asking? And the answer is almost always yes. So this is something we do when clients first come on board. We do a checklist. So we look at, kind of 3 tranches: before you move, just after you move, and then ongoing issues. So issues before you move, if you need help getting a visa, buying a house, selling your house in the US, moving to an expat-friendly custodian, opening a bank account, maintaining your old bank account, anything that we don't do in-house. In the countries that we operate in, we have partnerships with different professionals who we vetted, who work with our clients, who we trust, who we can recommend that you work with. So we kind of go through these checklists just to make sure nothing is missed. And then I kind of wanted to just kind of go over 5, maybe not the top 5, but 5 financial considerations for expats. So the first one is cross-border financial planning and investing, custody tax issues, portfolio considerations, and then mistakes to avoid. So the first one here, financial planning. So what is financial planning and what is cross-border financial planning? So what we do is we take a comprehensive overview of your financial situation. We prepare 3 personalized financial statements. So an income statement, looking at all of your sources, passive and active income, versus your expenses. We do a balance sheet, looking at your total assets, and we do a statement of cash flow to see when those income streams are hitting. We take that and then we project it into the future. So maybe you're a young person planning to save for retirement. Maybe you've just retired, you're moving over here, you have new expenses, you're not sure, how your passive income is going to meet your lifestyle expenses. We can include many different scenarios in the plans. We can run different versions. We can incorporate goals you might have, buying a house, renting, which is better for you. Maybe you want to fund children's higher education, grandchildren's higher education, whatever essentially you want to do, we can try to incorporate it into the plan. And then what does the plan do? Hopefully, it gives you peace of mind. So it makes you feel better about your situation, or it's a catalyst for change. The other thing it does is it gives us a lot of information. So it's data driven, so it gives us information. Maybe we need to be more conservative in your investment portfolio. Maybe we need to be more aggressive. And that's good to have. The second biggest issue, which we talked about before, is custody. So who can you work with as a US expat? So I mentioned some of the names, Fidelity, Vanguard. A lot of these places don't work with US expats anymore. The 2 that we work with are Interactive Brokers and Charles Schwab. There's benefits to each. Both of them are in the US, so your account is still in the US. You're still getting 1099s on the taxable accounts, which make people like Michelle happy when they're filing your US tax returns. They're in US dollars. The prices in the US financial system are generally much lower than if you were investing in a European bank. But you do have options. You can invest in the EU. We have partnerships with banks in different countries, as well as with Interactive Brokers. On the taxable side, your account can be custodied in Ireland, still part of Interactive Brokers. And then you have to look at cost factors. So if you're investing in an account in the US with Charles Schwab, there's no trading costs. If you're investing in a Swiss bank account, the trading costs are usually considerably higher. So we always look at a fee comparison from the US versus abroad. We ask the question, why? Why do you want to move your account abroad? The US is a pretty good financial system, and there are some very good specific reasons to move your account abroad. But if you're trying to do something like, avoiding the US dollar, so maybe you want to have currency exposure to the euro. Well, we can do that with a US custodied account by buying euros or by buying, indirectly European assets through a US fund. And I'll discuss that in a minute. The only big issue, which I would say, is if you want to diversify away from the US financial system, that's kind of a legitimate reason for looking at custody in the EU. And that's something that we can talk about on an individual basis. So other issues, tax reporting, it's very important to have the US 1099s for taxable accounts. And then in general, you want to be tax compliant. You don't want to be buying instruments that PFIX, that would be a big problem for your US returns. As Michelle said, if you go to a local broker or bank, they're happy to sell you funds that will be a problem in the US returns. So we in general say keep your money in the US unless there's a specific reason otherwise. Also, safety. In the US, we have SIPC insurance, which is up to $500,000 per account. In Ireland, for example, I think it's around 22,000 euros. So it's important to, keep that in mind. We hope there isn't another financial crisis, but I'm sure everybody that was with Lehman, never expected that to happen in 2008. Compliance, I think we talked about that. Making sure if you do get audited, having all the reporting forms is nice. And then working with a tax preparer who understands the joint tax treaty is paramount. So if you work with an accountant in the US for years, you move overseas, you might trust them. They might have done a great job for you, but they probably don't understand the joint tax treaty with the new country you move to, and that always ends badly. Filing in the US every year, avoiding the PFIX is important, and then filing usually in your country of residence and then paying taxes there, filing in the US. We always, if you're not working with an expat preparer, we always advise that. and then making sure that we manage your portfolio in a tax efficient way, which is different in every country. So for example, in Spain, capital gains, long-term capital gains are taxed at a much lower rate than dividends and interest. So in some cases, it's better to live off long-term capital gains than receiving dividend and interest payments. So how we manage your portfolio is, very important from how much you're going to be paying in taxes as well. And then how we manage the portfolio, if we're using individual stocks, for example, we can better manage the capital gains that way than if you're using exchange traded funds. Portfolio considerations. So currency is a big issue. Everybody's worried about currencies these days. There's a lot going on if you haven't been following the news. So we hear a lot, I'm concerned about the US dollar. And that's a valid consideration. The US dollar has historically been a very strong currency, so has the euro. But the risk is if all of your money is in US dollars and you live in the euro, that's a risk. So your expenses and your capital don't match up. So we need to actively manage that. And we do. There's a couple ways to manage it. You can manage it indirectly, which means you hold, for example, a US exchange traded fund trading in US dollars, but all of the underlying assets are European companies denominated in euros. So that's indirectly addressing the currency risk. To directly address it, you would buy European companies trading in euros. So we can trade on the European exchanges. We have an investment portfolio of European value stocks, European growth stocks, as well as individual bonds that we can buy. And those are held in euros. So that's directly addressing the currency risk. You don't have to convert that then if you want to live off that money. It's already in euros. So that's another way to do it. And then moving money. So say you're in the US, you have money in US dollars, you want to buy a house. How do you move money from US dollars to euros in the most cost efficient way? Let's say there's three ways. If you go to a bank, you go to Chase in the US, you want to wire to your bank in Portugal. They're probably going to charge you around 3% of the total value to do that transaction, which is a lot. If you go through a currency broker, someone like MoneyCorp, Spartan FX, Wise, they usually charge between 0.25 and 0.5 of 1%. So much better. Or we can do it for you. We can convert the currencies in an account like Interactive Brokers and wire out euros. And that's usually going to be around a quarter of 1%. What instruments can you buy is also very important, and it depends on which country you live in. So what I was talking about earlier with the kind of workaround and holding US ETFs, with Charles Schwab, for example, their stance on this PRIPS legislation, which limits you being able to buy US ETFs as a retail client. The other option is being an institutional client. So if you work with a firm in the US, like a registered investment advisor, Schwab's view on this is they're not offering the person in Portugal US ETFs, they're offering the institution in the US ETFs. So they let us, for example, trade on your behalf US ETFs. I should note that the accounts, they're always in your name, but we're allowed to buy and sell them for you through the US firm. And that gives you a lot of options then. It's easier to get diversification in things like emerging markets, buying an ETF, than if you were to pick 15 individual stocks in Vietnam that you like. And it's also maybe less liquid. So there's a lot of advantages to having access to US ETFs. Individual stocks in the EU or the US, there's no problem there. We can buy those. Individual bonds. Mutual funds, you cannot buy. You can't continue to hold them even in most cases once you move to the EU. They're an investment company under the law, and they need to be registered and regulated where they're offered. So if they're offering them to you in the EU, they're not, so you can't continue to hold them. Another question we often get is, can I own euro-denominated stocks and bonds that are custodied in the EU? And that's one of those reasons why you would want to have money outside the US if you're concerned about the US kind of financial system. And you can. There's a couple options there. You can go to, we have relationships with some banks. A lot of European institutions don't work with US people anymore, but Interactive Brokers does. They're a good option. So our recommendation is to always invest in a diversified multi-currency portfolio of global assets. And then looking at some more portfolio considerations, diversification. How do you get diversification? So if you want to be diversified, you should be diversified globally. Oftentimes, if you're coming from the US advisors, your portfolio is going to be around 80 to 90% US stocks. Our portfolios right now are around 50% US stocks, 50% international stocks. And then of the international stocks, we're looking at developed countries as well as emerging markets. So being diversified globally and having, in that sense, you're getting more currency exposure as well, which should reduce your overall volatility of your portfolio. We also hold around 10% of the portfolios in gold. And that's done, gold hit an all-time high, I think two weeks ago. But in general, the idea of holding gold is it evens out some of the volatility in the portfolios. Whenever there's inflation or geopolitical tensions, the price of gold tends to go up. So I guess that tells you a lot about what's going on these days. And then risk. Whenever we're looking at any assets, we want to consider the risk of those individual assets as well as being part of the overall portfolio. Expenses, I always say take a holistic view on expenses. So you don't want to look at an advisor's fee, a fund fee, a platform fee. You want to look at the whole package when you're evaluating who to work with. And then I think in general, what we can control as advisors is diversification, risk, and fees. What happens every day, it's not really up to us. Tax management, managing your portfolio in a tax efficient way. Like I said, it changes by country, and it's important to look at the individual situation in that country for how to put together an efficient tax plan, and then building a strategy and sticking to it. I wanted to include a slide on real estate. I think it's important if you're buying a property, you need to ask yourself, is this a home or is it an investment? And those are two very different things. If it's a home, you need to consider, should I be renting or should I be buying? In the US, generally speaking, people buy their home and when they move, you buy a new home. In the EU, I'd say it's more, you can rent and still find good places. And I think it's sometimes more recommended if you're moving from the US for the first time to rent for a year or two, just to get an idea of the city, your surroundings. That's the non-financial advice, but just to get an idea about the situation before you jump into a property. And then if you're buying a property, you need to look at the risk on it. So we'll talk about that. But if you're buying a property for an investment, you need to treat that like any other investment. It can't be a romantic investment. It has to be risk versus reward. So we're looking at an individual property versus a real estate investment trust, for example, which is a pooled real estate investment product. And if you're looking at that, we need to compare things like yield, capital appreciation, and risk. Individual house, there's a lot of risk there. If something happens to that property, it's a concentrated position. If you're looking at risk for a real estate investment trust, the risk is spread across multiple properties. If you're looking at yield, that's somewhat easier to compare, although it's important to consider all the additional costs over here, owning an additional property. And sometimes if you're a non-resident versus a resident, the taxes are different. And then capital appreciation. Individual properties probably have a higher reward potential, but they're also more risky. So we look at all that in our financial planning as well. Buying a house, and there's a lot of paperwork in the EU. I think working with an attorney is paramount. And also, I'd recommend a buyer's agent. So most countries now have buyer's agents for real estate, and it's a good idea to get somebody who knows the market and who's negotiating on your behalf. So I'd say having those people on your team is quite important. And then some mistakes to avoid. I think we covered all these. PFICs, shouldn't buy those. Insurance is another important thing. So if you have health insurance in the US, make sure that's going to cover you when you come over here, if that's your plan, and vice versa. If you have health insurance in Spain, for example, make sure that's going to cover you when you go to the US. Same thing with life insurance. If you have a US life insurance policy, make sure that covers you abroad if you pass away in the EU, and the other way around. Over investing in your country of residency, sometimes we hear, I'm moving to Germany, I'm investing in 100% German companies. That's too concentrated. You still need to have a diversified portfolio. Not understanding the underlying currency exposure of your portfolio. This is going back to directly addressing currency risk versus indirectly. So if you hold all of your investments are in US dollars, but some of the underlying assets are held in euros, European companies, you're still addressing currency risk that way. And then contributing to a non-qualified foreign pension. Michelle talked about that. Always use someone who understands the joint tax treaty and is familiar with the US side. I think, again, if you invest in a foreign bank or a brokerage house, you're probably going to be paying more than you would be in the US. And that's something important to consider. And then also not reporting things on your US returns like a foreign business. That could be a big surprise. And then I want to end with saying, it's overwhelming to look at all of this. There's too much information. So I think it's important to look at it in small pieces. And if you're planning a move, if you haven't moved yet, this is a lifestyle choice, becoming an expat, moving to the EU. So you might be spending more in taxes. You might be, higher cost of living, but that's only part of the decision. And I think that's an important thing to note. But in terms of research, check out all of the partners you're looking at working with. Read up. There's a lot of information online now about moving abroad, becoming an expat. Make an informed decision and enjoy. That's all for me.
Excellent. Thank you so much, Shane. We have a very active Q&A box, so thank you very much. We'll try and get through as many as we possibly can. And then we'll certainly share our email addresses at the end where you can reach out to us with additional questions. But the first one for you, Shane, actually is there's quite a few people who ask if you can just give an overview of your fee structure if they want to reach out and work with you.
Sure. Yeah. Our fee structure, if you're in the US, you can work directly with our US firm. And the fee structure is we charge a flat fee on an annual basis based on the assets we advise. So the first 500,000, we charge 1.5%. From 500,000 to $1 million, we charge 1.25%, and then anything above $1 million is 1%. If you're already in the EU, the relationship is originated there. You work with the Spanish firm, we charge 1% plus VAT, which is 0.21%, and then half of 1% from the US firm.
Thank you.
I can send that in writing if anybody wants it.
Need some more details. Yes, thank you. I think what I'll do is I'll maybe jump between the two of you so you have some breaks in between. So the next one, Michelle, there's a few questions around the FBAR, and somebody asked, could you clarify whether foreign retirement accounts needs to be reported on the FBAR, and if we're not taking, even if we're not taking any distributions?
Great question. Wonderful question. Love this question. The answer is yes. The long answer is it depends exactly on the type of foreign pension that you have. But generally the answer will be yes. If you have the type of private pension, meaning an account that has your name on it, so not a public social security account or something like that, a private employer pension fund, even if you're not receiving distributions, the value of that account needs to be reported on the FBAR in 8938 every year. There are some accounts that are people have no idea how much is in the account because they're just going to get a certain benefit when they retire. These accounts also need to be reported on the FBAR. They'll be reported with a zero balance. And then once you start receiving distributions, you report the amount that you're actually receiving on the FBAR every year.
Okay, that makes sense. Thank you. Shane, so next question is for you.
Sure.
There was a question regarding US mutual funds and why European residents are often restricted from buying them.
Yeah, if it's a US mutual fund, you're restricted because those need to be licensed and registered where they're offered. So they're registered and licensed in the US, they're not in the EU. So they can't offer them to people in the EU. And the way they view it kind of is where it's consumed, so to speak. So if you're living in the EU, they can't sell them to you. So the US custodians block those transactions.
What's any advice for a person in that situation? Rather just avoid the US mutual funds and
Well, usually what happens if you move over here and you tell your US broker that you're moving and you transfer your accounts, then they're probably going to sell those in the, IRAs, 401ks. They're not going to let you hold those once you move over. Or they freeze them so you can't add to any new positions. So we've seen both. Sometimes like Fidelity, I believe they'll freeze them so you can't add to them. Sometimes you can get it so they'll reinvest dividends but you can't buy new positions. And I would say advice, if they sell them, you need to find a solution. If they don't, and you don't want to work with a financial advisor, you could probably continue to reinvest the dividends in those, and you need to find a solution at some point because your account will get out of balance. But
Okay. Michelle, again, FBAR question. If someone files an FBAR late, is a penalty always imposed, or are there situations where the IRS might waive the penalty?
A penalty is not always imposed. It is very easy to file a late FBAR. There's actually a little drop down box on the FBAR when you're filling it out that says if you're filing late, tell us the reason, basically. One of the options for the reason, I didn't know I had to file, my foreign account statements were late. There's lots of different options that you can pick there. Generally, if you are a non-willful filer, meaning you weren't intentionally like, I'm gonna not file an FBAR and I'm not gonna tell the US that I have my assets there. As long as you just forgot or you didn't know, something like that, in a lot of situations, there won't be a penalty for you if you're a voluntary filer. There are situations in which if you need to get caught up on a lot of FBARs, there are compliance programs that you can use to make sure you're not owing penalties. So yes, there will not always be a penalty imposed. There are a lot of situations in which a penalty is not imposed.
Shane, next question. I once heard that by being designated as an accredited investor with Swap or other brokers, one could continue trading US ETFs while living in Europe. Is there any truth to that?
yes, that's true. Depending on the country that you're in, if Schwab operates in that country. So every September, I think Schwab publishes a list of the countries within the EU where they work. And there's kind of three different varieties there. You can open new accounts, you can maintain existing accounts, or they don't work in those countries. If they work in those countries and you're designated by either Schwab or a European firm like ours that you're an accredited investor, you can buy US ETFs.
Michelle, Social Security income. So somebody wondered if it's considered tax-free if I'm a tax resident in France or some other European country.
Okay, so it depends on the European country that you're living in. France in particular, US Social Security will be taxable on your US return. I think, I'm not a French tax preparer, but I think France then does not tax that income. There are some countries that you live in the EU that will also tax US Social Security income. So both countries are taxing Social Security. There are some countries like France, which only the US will tax it. And there are some situations in which US Social Security is only taxable in the resident country. So it totally depends on the country that you're living in. But for France, it's going to be reportable and taxable on your US return.
Then there was also a question around, I think somebody needs both UK and US tax filing support. And I'm happy to report that as of probably about 2 weeks ago, Greenback is actually offering both of those services. So yes, I think it's probably ideal to work with one firm who can handle both sides. So yes, happy to report that we can be a solution to that problem for you. I believe there was another person who asked if we only cover, yes, US taxes. Well, now you know it's US and UK. Right. Another tax question. So this individual, they are a US citizen living in the Netherlands, and they plan to marry a Dutch citizen. Given that we both have significant assets, are there any general US tax pitfalls I should be aware of when marrying a non-US spouse?
So, okay, interesting question. Generally, when you are marrying a non-US person, you will start filing US returns as married filing separate. The US still has no right to tax a person who's not a US citizen, a US resident, or a US green card holder. So if their only relationship to you is that you're married, it doesn't mean that all of their income and assets will now be reported on your US return. Actually, they cannot be. There is a tax selection you can make so that that happens. Generally, we advise not to do that so that you can have one partner that's perhaps making certain investments that are not beneficial from a US perspective, but maybe beneficial from an EU perspective. But some things to keep in mind, for example, okay, sorry, maybe this answer is getting a little long, but for example, if your non-US partner starts a business, starts their own company, they own their own company, there may be situations in which you need to report some things about that business on your US return, even if you're not in any way involved in the business, just because your partner owns and operates it. But generally, your partner's assets will be kept off your US return unless that partner becomes a US citizen, green card holder, or resident.
Excellent. I a little bit of personal information, but I am in the process of marrying a Swiss citizen and I'm a US green card holder. So this is very helpful information just for me myself. So I appreciate the long answers. Another tax question. So this is around PFIC. And the question is, what is the highest possible tax rate that could apply to income from a passive foreign investment company?
So currently, I believe it's 37%. Obviously, that will change. The tax rates generally change with presidents sometimes. But yeah, right now it's 37% will be the rate for PFIC assets. Yeah.
Okay. Maybe one last question, and this one will also be a tax question. So this person, they have a WISE US account with currency balances from that has IBANs, IBANs assigned for incoming transfers. WISE states that these IBANs are not owned by this individual, but are used for routing purposes. Do I still need to report these balances on the FBAR?
So this is a gray area. You will find a lot of preparers who say yes. You will find a lot of preparers who say no. There's plenty of evidence on both sides. I think there's not a very conclusive statement on that from the IRS. Generally, when I get asked this question, I would say report it. The reason is that there's no tax due on anything you're reporting on the FBAR, so you're not paying a balance or something. There's no real incentive to leave it off of the reporting. And it's not against the law to over-comply. It's not against the law to provide an account that you don't need to, but it is against the law to not provide an account that you should have been reporting. So generally, whenever there are these kind of gray assets, I advise that it's best to just report them. It sounds like that doesn't meet the hard definition that the IRS has for owned assets, but why not report it if you can?
Yes. All right, excellent. Well, that brings us to the end of our presentation. Thank you so much to everyone who joined us today and for all the thoughtful questions. It's clear these topics really resonated with many of you. And also a big thank you as well to our presenters for breaking down these complex cross-border tax and investing issues in such an approachable way. If we didn't get to your specific question, which unfortunately we certainly didn't get to all of them, or if you'd just like to discuss your personal situation in more detail, please feel free to reach out after the webinar. We'll be happy to continue the conversation and guide you through your next steps. I'll go ahead and share our contact information in the chat box now. And let me make sure you all get it. Right, so there I shared my own email address, and then I can go ahead and introduce you to Michelle or any of our other accountants who might specialize in different types of tax forms or tax account countries. We cover over 190 countries, so feel comfortable. We'll probably be able to cover that tax US treaty. And then Shane's email address is also in there. If you have any financial advice needed, please feel free to reach out to him, and the team will be very happy to assist you. And on behalf of the entire team, thank you again for all your time today. We hope you find this session valuable and look forward to staying in touch. Have a great rest of your evening, as I assume most of you are probably in Europe.
Thank you, everybody.
Great. Thanks, everyone. Bye.